is the March-June, as you can see in the corner up here, 2022, one of the exam questions that they've recently released. The first one was Tread Company, and this one now is called Clean Feet Company. So Clean Feet Company is a divisional performance question, and it has 3 parts. The first part is a calculation part. The second part is a performance evaluation for 12 marks. And then the third part is discussing return on investment as a performance indicator. Most of it is written, okay? Well, I should say that there's 4 marks here for calculation, and there's actually 4 marks going in the next session for calculation. So there's 8 marks going for calculation, and therefore there's 12 marks going for writing. Now, I just want to clarify for everybody, your exam is called performance management. Therefore, the examining team have said that you will get a performance evaluation question. And they could be from the divisional performance area of the syllabus, or they could be from the not-for-profit area of the syllabus where you do an evaluation. They could be a balanced scorecard question, a building blocks question, or a type of profit ratio analysis question with non-financial indicators as well. You are going to have to do a performance evaluation of some kind, okay? And so therefore you have to be good at calculating ratios, which means something, and explaining what you think is happening using the scenario. So that is a given. One of the 2 in your section sheet will be one of those types of questions. I don't know what, but it will be one of them. Right, so this one is the divisional performance question. And actually, this first part is similar to a previous question called Cardale, which they put out there. So they are kind of using questions that they've done in the past and reinventing them. Now, the whole question's not similar to Cardale, but the calculation element is. And what you need to do with these divisional performance questions is be really careful about what you're looking at and what you're asked to do. So read the scenario carefully. So first of all, it says for each of the division, the return on investment for the year ended 31st of August, 20x9. Okay, so we need to calculate that for each of the divisions. And then number 2, the amount of bonus each of the managers will receive. Okay. So we've got profit statement here, we've got some balance sheet data here, and then we've got some non-financial indicators at the bottom. So performance evaluation question. But for this part, we're obviously going to just need the profit statement and the balance sheet. So Clean Feet is a large supplier of environmentally friendly products. Okay. The company is split into 2 divisions. So we're going to call HG and Personal Care Division PC. All right. So you can use those, HG and PC. You don't have to define them because they've defined them for you. Do not start writing Household Goods Division when you're writing your analysis. It'll take you too long. The 2 divisional managers are responsible for generating revenues, controlling costs, and both make all of their sales and purchases on credit, having negotiated 30-day credit terms, both customers and suppliers. Whilst the divisional managers can authorise capital expenditure up to 50,000, any expenditure over this amount is controlled by the head office. So you need to think about that. We're actually going to be calculating a return on investment, but they don't have any control over the majority of the investing. All of the head office running costs are shared equally between the 2 divisions, and it's included in indirect costs. Well, you have to think, is that a fair policy? Why is it shared equally? Normally, you would allocate head office costs based on potentially heads, potentially the size of the business. Sharing them equally, they're telling you something there. Now, the performance of each division is assessed by the head office using return on investment. Oh, that's what we need now. And it's based on net assets. So it's not saying anything about their one is based on net assets. It's not saying controllable net assets. It's based on net asset. Each of the divisional managers paid an annual salary plus an annual bonus on the ROI of each division. And then we've been given some information about how to calculate their bonus. So the bonus is a minimum of 15% ROI, otherwise they won't get any bonus. And then every whole percentage above that, they get 3% of their salary. And there's a max of 10. Okay. Now, during the year, 31st of August, the head office decided to invest $2 million in a new computer system. Division HG was the only one who got that. Against the advice of the divisional manager, it caused a lot of customer order disruption. And so a head office decided it would not do it for the PC division. So if we have a look at customer complaints, it looks like we've gone up quite a lot, although it has gone up there. And we look at orders, it looks like our order completion has gone down, and theirs has not gone down very much. So there is definitely an issue because of this, which we'll probably be talking about at some point. So I think we've done enough reading to be able to do this return on investment. Now, I'm going to try and do this, right? But sometimes it works and sometimes it doesn't. It'd be nice if it did work. Copy and paste for you in the exam. But you see, it doesn't always work. No, it's not going to work for me today. It did work for me earlier, but it's not working for me now. You just now need to type it in as quickly as you can. So HG, PC. So we need, for ROI, we need profit over net assets. So I'm not going to write out direct costs. I'm going to write DC because I'm going to make sure I do this quickly. And so I need 12,655. I need 22,834. And it'd be really lovely if it had a copy and pasted in, because then I didn't need to type these out, but I've just got to get on with it. You try it once, and if it doesn't work, you just have to move on, because otherwise you're wasting time. 4023 and 6078. So hopefully it will work for you. So profit is therefore one. No, they haven't told us about controllable profit. So you just have to assume that it's profit, because they haven't said what to exclude. They haven't told us what's in any of these to exclude. So we have to use the whole lot. So once you've done the formula once, copy it across. So those are my profits. I now need my net assets. So inventory, cash, trade receivables, trade payables, overdraft. We've got 14,570. Right, so now the net assets at the bottom. Remember what you do. You add non-current assets to inventory, to cash, to trade receivables. But you minus, make sure you do that, trade payables and the overdraft. That is net assets. And therefore you can then copy that across and do the same. So now we just simply, don't tell me how to calculate ROI. I can see it in here. We simply take profit and we divide it by net assets. We want to see it as a percentage, so click on there to 2 decimal places and then copy that across. So that's part A done. A, make sure you label it. Therefore, they know it's the answer. It's always nice to put a highlight. Okay. So now we can do the bonus. So I'm going to do the bonus up here, A2. And so copy across your labels, because otherwise you're just writing them out again. So the 2 managers are going to get a bonus above 15% ROI. So 15% ROI, how much is that minus the 15%? So it's a percentage again. It's 1.94. And again, it's 9.93. Right, so we need whole percentages above though. We need whole percentage, whole 1%. So that is only 1. Yeah, it's 1.94 is not 2, it's 1. That is 9. So therefore, they get 3% for every one. So they're going to get 3. And they're going to get 9 times 3 is going to be greater, isn't it? 9 times 3 is going to be greater than 10. And remember, we have a maximum of 10. So therefore, the maximum bonus is going to be 3% for them and 10% for them. And now we have to calculate their bonus, and the bonus is calculated on 180,000. So the bonus finally is the answer for HG is going to be that times 180,000. Sorry, that's 3%, not 1%. And that times 180,000 is 18. So HG bonus is therefore that. So that's answering 1 and 2, and that was 4 marks. Let's move on to the next one. So what it's good to know is you probably are going to have to use these figures, right? So you are going to have to remember to come back and have a look at these. And you potentially could still use the spreadsheet to help you work some things out. Because what you'll realize is when we go to the next thing, it says, using your answer to part A and the data provided, so using your answer to assess the performance of each of the divisions, including the management of working capital. There are 4 marks available for calculations and 8 marks available for discussion. Right. So that means you should really be creating a table that you can use to do some analysis, because you want to get those 4 marks. And you will get half a mark per comparative ratio. All right. We should really be calculating a profit margin, but I'll have to calculate them for both divisions. They've asked us for working capital. So you should be doing your trade receivables days, your trade payable days, inventory, maybe a current ratio. You could look at the orders, because they've already given you the percentage. You could say to yourself, well, what's the order gone down by? What are the customer complaints gone up by? They would give you half marks. Now, this is 12 marks, so this is not going to take 40 minutes, is it? So you've got to think to yourself, how much time have you got? Maximum time you've got to do this, I would say, would be 24 minutes, because I'm just doubling the 12 marks. Do not go over time on this, because you're only going to get 8 marks for discussion. So you don't need to write loads to get those 8 marks. You just need to plan your answer carefully. So you should plan your answer around what they've specifically asked you to do, including the management of working capital. If you miss that out, then you're missing out loads of marks. You should be talking about ROI and profit, because you have actually just calculated ROI. You should be talking about working capital. And then you should look down and think, oh, there's also customer complaints and orders. So you can talk about the customer, and you could talk about staff turnover. You may not get round to all of this, but you should also at least think about putting a conclusion in. Okay, those are the things you should be looking at. And therefore, you need to calculate some ratios to help you do all that. And so you need to put a table in. So if you're thinking you're going to get half a mark, then you need 8 ratios. So stick a table in that you're going to need 3 across. And the 1, 2, 3, 4, 5, 6, 7, 8. You might not use them all, but it's easier to put them in now. All right. Now this one's going to be called HG, and this one's going to be called PG. I'm happy to write things like net profit margin. You probably want a gross profit margin. You want to potentially have your inventory days. You need receivable days. You've got your current ratio. And then you can look at some others once you've started going. So then you just need to get your calculator out, and don't show me how you've calculated them, just do them. You could go back to your spreadsheet and do the calculations in there if you find it quicker, and then note them down in your scratch pad. That might be a way of doing it. If you find it quicker and you don't have to then type everything out, you could do your table down here. You don't even have to label it, because you'll know what it is. So you could do your profit margin easily by doing that divided by that. And then you can write it down on your pad. So you've got 22 and 24. Then you've got your gross margin, which is going to be just your sales minus your direct costs. It's just thinking of getting the calculations because that's where you're getting them quite a few marks in this question. I'm just going to say that's my net margin. I know that will be my gross margin just to help me. And because it's much easier because you've got your figures already here. You've got your inventory days, so you can already do that divided by your cost of sales times by 365, 81. Copy it across and you see it's just so much quicker. Can you see? So I'm doing my inventory days, then I've got my receivable days and my payable days. Obviously, payable days is also over the cost of sales figure. You don't include indirect costs because they're not like purchases, the one that's closest to purchases. So there's my figures. You can now then pop your figures into here. And then once you've got your figures, you think to yourself, have I got time to do any more? So I might do the customer complaints, but only when I get to it. So I have prepared something slightly earlier, which should be down here. So here's my calculations, which I've put in. All right. You probably don't need to put the days in. And then my current ratio. Oh, I could have done my current ratio easily as well in here just to show you. So current ratio, because it's all here, is much easier to do, is to do add inventory plus cash plus trade receivables. Put it in brackets. And then divide by that plus that. So current ratio is 4 and 1. That's probably not correct. Probably need to put that into a higher number. So again, I'd probably note those down. You may find it quicker to actually just do it in the calculator, but I've got them all there and I know that they're correct because I've used the Excel spreadsheet. I've now put those into my answer. All right. I've also then done customer complaints, and I've basically done a growth in customer complaints, which is 2% over 0.2 minus 1. So I've just done 2 over 0.2 minus 1 times 100 gives me 900% increase. It just makes it look really bad, doesn't it? And then 1 divided by 0.5 minus 1 means they've got 100% increase. Then I've got change in the staff turnover. There was no change for HG, but there was 125% change for PG. So those are my 4 marks. So then I've gone on to doing some analysis. So first of all, I've gone into ROI and profits. And what I'm doing is I'm trying to use the scenario as much as I can and copy things in. So I would basically say, remembering from my previous section A, the ROI is 8 percentage points higher and the net profit margin is 3 percentage point higher. If you want to put your ROI in here, it won't get marked, but if you wanted it for reference. So remember the ROI was 17% for HD and 25%. So that's where we've got 8 points higher and the net profit margin is 3 points higher. So why is that? Well, PC is the larger company, so you potentially would expect it to be higher, but all of the head office running costs are shared equally. So I've got that from there. All of the head office current costs are shared equally. So I've literally copied that into my answer. So I'll just put it up here so we know where I put it. Oh, that works. That was at least, right? So I literally copied that into my answer. This is therefore reducing HG's profits unfairly. Their profits will be reduced unfairly because they'd be having exactly the same head office costs as them, yet HG is a smaller company. Can you see? It's practically half the size. So is that really fair? So if you look at the gross margin, they are actually performing better. They're 54% compared to 51%. Also, what also affects ROI is the fact that you're investing, and HG was the only one that got a 2 million new computer system. PC didn't. So we need to make that obvious. It's also been affected by the recent investment. Head office, I copied this from the scenario. Head office decided the new computer system into HG. All right, that's what I literally copied. The head office decided that a similar planned installation, which I also copied, did not take place in PC. So PC's asset base is where you've got to add value, is now comparatively lower, making the ROI inflated. So that is the reason why the ROI is worse on HD and PC. There's two reasons. One, because they've been given an unfair head office recharge compared to PC probably, and also they've had to been forced to invest in a new computer system and PC hasn't. Then get the management of working capital out, because they've asked you to do that. If you don't talk about it, then you're missing loads of marks. So here I've got the management of working capital. Now, there's not really much you can say apart from tell them what you've discovered. Both divisions have a policy of 30 days, so you can talk about that. Are they on those 30 days? Sorry, just go back up here. They have 30 days credit terms with their suppliers, so you can see that. HG has managed to collect cash from customers in the 30-day limit, because look, it's here, although it's late paying suppliers. So you're comparing it to that 30 days. It's got nothing else to compare it against. You can only compare it against each other or those 30 days credit terms. PC, on the other hand, is performing worse. So it is, because it's on 60 days and it's 73 days to pay its liabilities. Then you can talk about the inventory days. Actually, PC is better, but why potentially could HG be having a problem? Well, the new computer system. That's all you can say. It is noticeable that they've got an overdraft, so check who's got an overdraft and who isn't, so make that comment. So they appear to be managing their cash better because they've got cash and they've got an overdraft. The current ratio is pretty poignant to point out, 3.7 compared to 1.5. So overall, HG is healthier in terms of liquidity. You could have written that in there. Now you've got to remind yourself now, you needed 8 points. All right, you've got your 4 marks for your calculations. You're really pushing up to the 12 marks with all this. That's 1 mark, 1 mark, 1 mark, 1 mark, 1 mark, 1 mark. So that's 6 marks gone. You don't really need much else. So if you're pushed for time, move on. All right, move on, because you've got most of the marks, because there's no point in spending lots of time on this question to the detriment of finishing the next 4 marks. You can always come back if you then finish the next 4 marks in time. So although I will carry on talking about this, you might be up on your time here, so you have to stick to time. So here I'm going to talk about customer and staff turnover. Now, because I've done those calculations up there, let's comment on why it's so obvious why their customer complaints have gone up. So because the Ed Office, I'm going to copy this again, decided to copy that completely into my answer, so I didn't have to write it out. This has affected the customer complaints and seen a 900% increase, and order completion has fallen by 19 points. PC looks better than HD, but there has been deterioration. And the only thing I can think of which would to explain the deterioration in customer complaints is it might be linked to the staff turnover. It's a 125% increase. So staff shortages and retraining may have resulted in internal process and quality issues. That's my little add on that. But I would have got 1 mark for that. So I'm now at 6 for 7. So I'm just about to max out. So I probably didn't even need to say anything about this. If I then put a conclusion in, that's my 8th mark. So this is worth 10 marks basically. So just be aware of the fact that you needed to make 8 points that are well constructed. So that's my game plan for something like that. So you need to make sure you do enough calculations to get those 4 marks, and then think about structuring your answer to get the 8 marks. So I probably would have spent most of my time talking about ROI and profits and working capital, brushed on customer because it's there and it's easy to say what's happened, and then do a quick conclusion. Now we move on to the final 4 marks, which is discuss whether they're using the return on investment as a basis of assessing divisional performance and calculating bonuses at clean feet. So they say at clean feet, you have to use the scenario is appropriate. Don't write the answer that you've learned from another question. It has to be applicable to clean feet. So lots of students in the real exam went on and on and on about that the divisional manager will stop investing. Well, they're not allowed to. They aren't the ones who authorise it. It's very clear they can only authorise it to capital expenditure of 50,000. That's the problem. They don't have any control over it. They only have control of capital expenditure up to 50,000. You can't say that they stop investing because they don't invest. It's the head office. Now you'll see you can say something, but you have to make sure you clarify it. So what I've done is split this. I've said assessing divisional performance is the first part. Calculating bonuses is the second part. And then taking into consideration any issues it may cause is the final part. So there's 4 marks going. So you need to make 4 points. So my first point is you can only use ROI as a measure if the divisions control everything that goes into the ratio. So first of all, the net profit is used, not controllable profit. The head office recharge is not controllable and it's not fairly allocated. The net assets includes non-current assets. Divisional managers can only authorise capital expenditure up to 50. Any expenditure is controlled by the head office. So again, this is not appropriate to use. Okay, that's the point we need to make. In terms of bonuses, HG is only getting a bonus of 1% and PC is getting a maximum of 10. Despite what we found out in our performance evaluation, they're performing better on controllable profits and working capital. What issues might this cause? Well, this is not fair. It will demotivate the manager, which is probably enough, but expand it, yeah? They're going to start acting inappropriately. Now, this one, I probably wouldn't have said, but it's, you know, because the whole point is we were saying they couldn't control capital expenditure, but they have put it in the answer. This may lead the manager to minimize the capital expenditure which they can control. So be careful about saying they can control. I would probably have said it will demotivate the manager. They'll cut costs inappropriately or simply lose interest in generating sales. That's probably the more relevant thing to say. Do not just say this is not fair and we'll demotivate the manager. What would actually happen if they're demotivated? What behavior would happen? And the types of things you need to learn for this is they'll stop investing if they are able to invest anything. They will cut costs inappropriately. They may object to the performance evaluation process and stop working towards the good of the business. They're not being bonused fairly and effectively. So that is 4 marks. They did say that they only give a maximum of 3 marks if you didn't say which issues it may cause. Right, so that's it. So therefore, if you found that quickly, then you could always go back and think, I've missed out a couple of points at the bottom, which I know I want to quickly write, and then I'll maxed out on marks, but I'm still within my time.